Right now, it feels like every time you pass a petrol station or fill up your car, the numbers are climbing up and up, and it's impossible to ignore. Petrol prices have surged to levels most of us have never seen at the pump, and behind what is causing that number to rise is a crisis that the head of the International Energy Agency has described as the greatest energy security challenge in history. Bigger than the 1970s oil shock and bigger than the Russia-Ukraine war. Oil was trading at historically high levels. The Strait of Hormuz is effectively closed and financial markets are rattled. If you have money invested or you're about to invest, you're probably asking yourself one question. Is this the moment everything is going to fall apart? And in this video, I want to show you what the data says, why the headlines are probably misleading you, and what to think about when it comes to your own finances. Section 1, the world is ending. Every generation has a moment that feels like this, and in none of them did the world end. Every decade typically produces an event that looks at the time like the moment the global economy is going to finally shatter and break into a million pieces. War in the Middle East, COVID, the global financial crisis in 2008, the dot-com crash, 9/11. Every single time it felt like the one that would tip us over the edge and we would never, ever recover from. And what history shows us is not that these events don't matter, because obviously they clearly all very much do. But what they do show us, though, is that your fears with regards to your investments tend to be worse than the reality. And the panic selling during these times will almost always be the biggest reason your assets do not perform than the actual problem itself. Investors who get hurt are almost never the ones who stay invested. They are the ones who panicked, moved to cash at the bottom of the markets, and stayed there until they thought it was safe to get back in again. I want to read you a list. The Ukraine crisis, COVID, the Evergrande collapse, Brexit, Ebola, the Eurozone debt crisis, 3 times, the Crimea invasion, the ISIS advance into Iraq. Those are just a selection of what one research group called stock market panic attacks since 2009, and they counted 74 of them, one roughly every 2 months for 15 years. Every single one felt different. Every single one felt like it might be the one that we didn't recover from, and all hell would break loose in the markets. And every single one turned out to be a buying opportunity. Let's cast our minds back to March 2020. You couldn't leave your home. Hospitals were overwhelmed. The economy was shut and markets dropped 34% in 5 weeks. Does that feel as alarming now as what's happening today? Because at the time, most people thought it was the bitter end. 12 months later, the markets had fully recovered and in fact were trading at even higher points. It's important to understand what the data tells us about geopolitical shocks and markets. Since 1980, the S&P 500 has experienced a drop of 5% or more in 93% of all calendar years, so 9 in 10 years. A drop of 10% or more has happened roughly half of all calendar years since 1980, and a full bear market, meaning a 20% decline, has occurred roughly every 3 to 4 years on average. Basically, what I'm trying to say is that market pullbacks and sell-offs are not exceptions. Volatility in the market, when things go up and down, is the price of entry. And across every single one of these events, the long run direction has been the same, up and to the right. The 1930s depression is the worst case study in market history, with an 83% decline. But even if you had invested at the very peak, just before everything fell apart, and kept investing consistently throughout for a minimum of 20 years, you would have come out the other side essentially untouched. Not rich, but unharmed. And the lesson is not that crashes don't happen, it's that investors who try to escape them almost always make things worse. So crashes are normal and they always feel unique. But knowing that doesn't make the urge to do something about it go away. Everyone is human after all. And this urge to move to cash, wait it out, then to get back in when things feel safer is exactly what we need to talk about next. Section 2, move into cash. It might feel safe, but we'll show you why it's not. When markets fall and the news is this frightening, one instinct takes over almost every investor at some point. Get out, move to cash, wait for things to calm down, then get back in when it feels safer. Logically, obviously, this sounds like perfectly good common sense. But the problem is that, like most things in theory, it never actually pans out this way. And it is one of the most reliably damaging things an investor can do. And the data on this is about as clear as data can ever be. I want you to think back again to March 2020. Markets have just fallen 34% in 5 weeks. COVID was shutting down the economies overnight. There was no vaccine, no clear end in sight, and headlines were predicting a huge depression was about to become upon us. Millions of investors moved to cash. Perfectly understandable given what was happening. It felt like the only rational thing to do as we were seeing things we'd never seen before. What followed was one of the fastest and most powerful market recoveries in history. The S&P 500 gained over 70% in the 12 months after that March low. The investors who moved to cash faced an almost impossible decision. Do you get back in when the market is already 30% above where you sold? Some even as high as 50 and 70% above where they sold, and most of them never did. They locked in the loss and watched the recovery about to happen without them. And obviously this is not unusual. It is the same pattern every single time. We put a lot of work into making sure everything we say here is accurate and genuinely useful. If you want more of it, please subscribe and hit like. It tells us that this is worth making more of for you. Here is why moving to cash during a downturn is so damaging, and it comes down to one simple fact. The best days in the market almost always happen right in the middle of the worst periods. So according to research from Hartford Funds using data going back 30 years, 76% of the market's single best days occurred either during a bear market or in the first 2 months of recovery, not after everything had calmed down, right in the eye of the storm. JP Morgan's data makes this even more concrete. 6 of the 10 best single trading days in the market over a recent 30-year period occurred within 2 weeks of the 10 worst days, often within days of each other as well. So what that means in practice is if you sell because things feel terrible, you are extremely likely to miss the best days that do the most to repair your portfolio, because those days come before the news gets better, not after. Hartford Funds calculated that if you had stayed fully invested in the S&P 500 over the past 30 years, you'd have earned around 8.4% per year on average. If you'd missed just the 10 best days in that entire period, 10 days out of more than 7,500, your return would have been cut roughly in half. Miss the 20 best days and your return drops to near zero. And miss 30 days, just 1 month, and you would have made less than rate of inflation. 10 days out of 30 years. It's nothing, isn't it? That is the margin by which staying invested beats trying to time your way in and out. So I hope that you've got from this that crashes are normal, and moving to cash during them tends to make things significantly worse than better. This brings us to the question that actually matters. Not whether now is a good time to invest, but whether your plan is built to keep you invested through moments exactly like this. Section 3. Can your plan survive moments like this? The question, is now a good time to invest, is the wrong question. It assumes that the right approach changes depending on what's in the news. But markets have been volatile for as long as markets have existed. There has never been a time when someone somewhere couldn't make a compelling case for why investing now would be uniquely dangerous. When markets are high, they're too high to get invested. When they're low, people are saying you are crazy to get invested. The more useful question is, do I have a plan that accounts for exactly this kind of volatility? And is it actually doing what I think it should? My client John was convinced during COVID that markets were never going to recover and that a second wave was coming. We had daily discussions on whether he should pull everything out as he was about to retire and was panicked he was going to lose everything. What calmed him down and stopped him pulling the plug was that we had actually always ensured his portfolio had 2 years of cash and short-dated bonds in place so that he could access this to fund his life. Because we worked that out, how much he would need, he could actually see how he would get through the next couple of years, and it ended up saving him from making one of the worst decisions of his life. He ended up being comfortable, not because the data said that markets would bounce back, but because his own personal plan said he'd be okay for the next couple of years and could ride it out. The plan ensured that even if there was a second wave, he would have chance to recover from it. This is exactly why a robust financial plan works. To test whether yours does, here are the questions worth asking yourself if you are not sure yours would hold up. The first is the time horizon. Money that will be needed within the next 2 to 3 years is generally considered unsuitable for equity markets. Holding a buffer in cash or low risk assets is one reason that a market downturn does not have to force you to sell investments at the wrong time. The question to ask is this: does my plan have that buffer built in? The second thing is diversification. The investors most exposed to the current situation tend to be those concentrated in a small number of regions or sectors. In other words, they have all their eggs in only one of a few baskets. A globally diverse portfolio spread across different countries, industries, asset classes has historically absorbed shocks that a concentrated one cannot. And the question to ask here is, where is my money actually spread? The third thing is process. Every major study on investor behaviour tells us the same story. According to Dalbar's long-running analysis of investor behaviour, over a recent 20-year period, the S&P 500 delivered an annual return of 9.7%, while the average equity investor in that same market only received 8.7%. That gap exists almost entirely because people move in and out of the markets trying to time events they cannot predict. The question to ask is my plan designed to keep me invested through volatility, or does it depend on me making the right call at the right time? Of course, this video cannot tell you what the right plan looks like for your circumstances. That depends on your goals, your timeline, and your situation. And it's something that should be explored with a regulated and qualified financial advisor. What it can tell you though, is that those with a good plan who stick to it are typically those who come through moments like this one in good shape. I want to finish with something that has nothing to do with oil prices or the Middle East. If you have spent the last 20 or 30 years building something, whether that be a business, a career, or a portfolio, you did not do that so you could spend the final years before retirement glued to news headlines, second guessing every single decision. You did it so that your money could work for you and your time would no longer be tied to a salary. You want to retire on your own terms and leave something behind that matters to the people you care most about. And that is what this planning is for. The point is not to predict what happens in the Strait of Hormuz. The point is to make sure that whatever happens next, your financial future is not dependent on you or your advisor having to guess correctly. The world has always found new ways to be frightening. The people who built real wealth across those events were not the ones who moved fastest. They were the ones who had a plan and stuck to it. If you'd like to understand whether your current plan is built for moments like this one, you can click on the link in the description box below to book a free conversation with a regulated financial planner at Hogston Wealth. And if you enjoyed this video, please subscribe to the channel for more content like this. Thanks very much for watching and have a great day ahead.